All right, so we're going to talk about the financial system. Financial system is going to help you understand how businesses and individuals get their money and how these money markets are in equilibrium. Just to start off with, if you think about buying a house or buying a car or buying just about anything, there's different ways you can finance capital investments. You could either borrow the money, perhaps from a bank or from a friend or relative, or you could convince someone to provide the money for your business in exchange for a share of your future profits, so borrowing or offering ownership. And there's a financial system that is a group of institutions in the economy that help to match one person's savings with another person's investments. So you have that matching going on between different individuals in this market. Saving and investment are key ingredients to long-run economic growth. When a country saves a larger portion of its GDP, more resources are available for investment in capital, and higher capital raises a country's productivity and living standard, as we've seen in the previous chapter. This chapter examines how that financial system works. So, what are the financial institutions out there? They could be grouped into two categories. The financial markets is a direct link. So the big idea here is a direct link between borrowers and savers. Whereas a financial intermediary, well, this word just clearly states that essentially it's works as an intermediate person in between the saver and the borrower. So we're trying to move money from scarce resources from savers and to borrowers whose economy is scarce resources, which is the money from savers, to borrowers. So we have people in society that borrow, we have people in society that save. So what are the main markets out there? Well, there's the bond market, the stock market, and the mutual fund kind of market, other than just borrowing and lending. So in the bond market, which could also be known as debt finance, is a certificate of indebtedness that specifies the obligation of the borrower to the holder of the bond. The price depends on the bond's term, credit risk, and other interest rates. So if we typically think of a bond, well, a bond is seen as an IOU. IOU is just like I owe you money. It's a piece of paper that's going to have like a maturity date. So it could be like in a year's time, in 10 years time. And it could say, well, in that much time, I'm going to give you $1,000 back. And there's bonds that have coupons or some that don't. But let's say we're talking about a zero coupon bond. Well, essentially, if you're going to buy this bond from this company, this piece of paper that says, I'm going to pay you this amount of money in this amount of time, you're going to pay something less than $1,000. That way, if you pay $900 and in a year's time you get $1,000, well, you've made that $100 worth of interest on that $900 in that year's time. So you're making a certain amount of money. That amount of money that you're making depends on the term. That's the amount of time, the risk. So if you lend to a company that's not seen as very creditworthy versus a company that's, or the government that is seen as very creditworthy, you'll have different implied interest rates. We'll talk about that more in the future when we speak about bonds and interest rates and money demand and money supply. But for now, just keep in mind how that bond system works. Just see it also as this idea that if this corporation is issuing a bond and you can buy it this year at $900 and it's going to give you $1,000 in a year's time, if all of a sudden another bank now sells this bond for less or for more, it's going to have an influence on the price here, and it's going to have an influence on the implied interest rate. We'll get more into that in the future. Stock is seen as equity finance. So you represent ownership in a firm, claim to its profits. So the value depends on supply and demand of the stock on stock exchanges, but typically the value of a stock is going to go up as the value of a company goes up. So you own part of the company. You don't get paid at a certain date. You essentially have to sell your stock to get the money. Whereas this, when it comes to maturity, you get your money. You can always sell it before maturity, but you can always keep it to maturity. Whereas the stock, you keep it, and when you decide to sell it, you could have made profit, you could have lost money on it. But if the company is growing and is doing well, typically the value of the stock is going to go up. Mutual funds is an institution that sells shares to the public and use the proceeds to buy a portfolio of stocks and bonds. So if you have extra money and you're a student or you're building up your wealth, mutual funds is an interesting idea, because you essentially have a portfolio manager that manages your stocks and bonds. Therefore, diversification and other things like that are not as big of an issue. Banks also stand between savers and borrowers as well, because banks can lend money to certain companies, and when you give money to the bank, you get a very minimal interest in return. Another thing that is interesting to look at if ever you're thinking about investing your own money and you think, well, stocks are risky because they're not diversified, and bonds don't pay enough, or I'm not interested in, because there's a certain level of risk. Even though you know you're going to get this amount of money in the future, there's a certain amount of risk that if the creditworthiness or something else changes over the time period, if you go to sell it before maturity, you might not get as much as you paid for it. But if you keep it to maturity and they don't go bankrupt, you will get your money. Another interesting one that's not mentioned here is the idea of using something that represents index funds. So it's kind of like an exchange traded fund, which will or known as an ETF, which will mimic like either the S&P 500 or the TSX or another stock index. And that stock index represents a lot of stocks out there. So if you buy something that represents the whole index, you have small ownership in many, many companies. Therefore, it's pretty well diversified. It's not perfectly diversified, but it's pretty well diversified. And the advantage of this over a mutual fund, woohoo, spinny, is this idea that over this mutual fund is that this is very easy to manage. This is harder to manage. So here you're going to have certain management fees. Management fees, which could be you'll have to look into the percentage, but it could be a couple of percent. So definitely takes away some of your profits there. Whereas over here, they're extremely small. So just things to keep in mind. We're going to look at how all of this works a little bit more in practice in terms of savings and investment in the next video.